It is 8:50 a.m. Pacific Daylight Time. It's the 12th day of March, 2026, and this is episode 1276 of Bitcoin, and seems to be a little row brewing between Jack Dorsey and Brian Armstrong. Brian Armstrong said some things, and Jack Dorsey doesn't like the things that he said. And if he did say the things that I heard him say, I don't like what Brian Armstrong said either, so Jack's got some good company here. That's going to be the very first thing that we talk about here on all the news you can use on the Bitcoin and podcast with me, your host, David Bennett, bringing you Bitcoin news and macro from around the world. Second thing up, crude oil. This is fascinating relationship between Bitcoin and crude oil, but this particular CoinDesk story is going to talk about the litro. And yeah, you can probably already determine what the hell that means. Is it stupid? Yeah. I love bringing you stupid shit. We've got to break up the monotony somehow, right? And then we're going to talk about Tether. They just refuse to stop investing in things. They keep reaching for stuff. They keep doing things, and they've done yet one more thing, and we're going to tell you all about it. And then Sam Bankman-Fried is really starting to annoy prosecutors. They're fighting. I mean, this is a man who's in jail. He wants to get out of jail. He's been pestering Trump, and now he wants a new trial. And I think some people they're just kind of done with this dipshit. I think this may be the one example of somebody who could potentially still be classified as having a whole bunch of money at his disposal to be able to do the things that other rich people with all sorts of money at their disposal are able to get away with. I think this may be the first example that we don't see that. I'll tell you why later. And then this SEC and CFTC seems to have shaken hands. They got a memorandum of understanding. That's going to be cool. Well, maybe not. Who knows? We'll find out together. What do we got here? Let's see. Her Majesty's Revenue and Customs Service. Ooh, you guys over there in the EU, be careful. It might be coming down the pipe. Then Chinese fraud victims. Remember the 61,000 seized Bitcoin that I was telling you about a few weeks ago? And I started saying, well, the way that they want to give this stuff back to the people that got defrauded in China seems a little, I don't know, a little dicey, a little shady, a little shadowy. Well, the Chinese fraud victims think that too. Android vulnerability is coming up, as well as Metaplanet. And yes, we are also going to talk about Cosmos Health. Just a little bit though. Promise, because it's treasury company stuff, but we are still keeping an eye on the pulse of how these treasury companies are being perceived in the public. So I think this is news that we can use. Coinbase. Let's go up to the front of the show. Coinbase CPO rejects claims of opposing Bitcoin tax relief as Jack Dorsey demands clarity from Brian Armstrong. This is Juan Galt writing for Bitcoin Magazine. Coinbase Chief Policy Officer Faryar Shirzad directly denied allegations that the company is lobbying against a proposed de minimis tax exemption for Bitcoin. Responding to or on X to a post by Bitcoin podcaster Marty Bent, Shirzad wrote, quote, "This is a total lie, Marty Bent. We have never and will never lobby against Bitcoin, ever," end quote. Though multiple people are asking for a public statement from Coinbase CEO Brian Armstrong on the matter, Jack Dorsey of Block specifically called Armstrong out for clarification, saying, "Hope this is true for de minimis as well, at Brian Armstrong, question mark?" Okay, well, the denial comes after Marty Bent reported on March the 11th that Coinbase is allegedly telling lawmakers the exemption is unnecessary because no one is using Bitcoin as money. A de minimis exemption for Bitcoin is a handout that will be DOA, end quote. Bent claimed the company is pushing for stablecoins only treatment to advance its own business. Bitcoin Policy Institute Managing Director Connor Brown confirmed a related development the same day. Quote, I can confirm that over the past 3 months, there has been a strong shift on the Hill, Capitol Hill, to limiting the de minimis exemption to stablecoins only. BPI continues to meet with lawmakers to explain what a strategic blunder this would be for the United States, end quote. A de minimis tax exemption would eliminate capital gains taxes and IRS reporting requirements on small Bitcoin transactions, solving a long-standing friction for the adoption of Bitcoin as currency. Under current law, Bitcoin is treated as property, so every spend, every buying of coffee, or every paying of a freelancer creates a taxable event that requires tracking cost basis and filing paperwork. Legislation backed by Senator Cynthia Lummis would set a $300 per transaction threshold with a $5,000 annual cap, aligning routine Bitcoin payments more closely with minor foreign currency exchanges. Supporters argue the change is essential to remove tax friction that currently discourages everyday use. Without it, compliance burdens make Bitcoin impractical for routine purchases and limits its function as a medium of exchange. Block Incorporated has been the most vocal corporate supporter. In November of 2025, the company behind Cash App and Square launched its Bitcoin is Everyday Money campaign, explicitly calling for the exemption while rolling out Lightning Network tools that let Square merchants accept Bitcoin payments with zero fees through the year 2027. Lightning Network data published by Bitcoin Magazine directly undercuts claims that Bitcoin sees no use as money. A February 19, 2026 article reported $1.17 billion in monthly volume. Every month, $1.17 billion every month in volume across 5.22 million transactions. In November of 2025, that is. And according to aggregated figures from River Financial covering more than 50% of network capacity, average transaction size rose to $223. A June 18, 2025 Bitcoin Magazine report showed the network had reached roughly 1.5 million users and $1.5 billion in trading volume. Block's own Lightning node produced a 9.7% yield routing actual payments, while Cash App handled 1 in 4 outbound Lightning transactions after a 7x usage growth. Block Bitcoin product lead Miles Suter summed up the company's stance, quote, if Bitcoin just becomes digital gold, we failed the mission. Bitcoin payments validate Bitcoin. They make it real. Bitcoin is money, end quote. The exchange of claims highlights ongoing tensions between crypto-focused platforms and companies building payment infrastructure for Bitcoin. With Lightning volume continuing to climb, advocates maintain the exemption would accelerate commercial adoption rather than provide unearned relief. Congress is still weighing the proposal with broader digital asset tax reform discussions. And there really wasn't a whole lot from Juan Galt in this article about what the fuck Brian Armstrong actually said to elicit all this response. I mean, I don't know, man. It's a little light on the facts here. So let me go back and look for this. There's a couple of updates here. Marty Blint claims to have 3 different sources on the rumor of the push against de minimis tax for only stablecoins, right? Or well, actually to push for only stablecoins having de minimis tax relief, but not Bitcoin. So Marty's saying he's got 3 sources on that. And then there's another update. Armstrong responded with the denial of the rumor, calling it totally false. Okay, well, but that's not... The only other thing I can see here is Connor Brown saying that he can confirm that over the past 3 months, there's been a strong shift on the Hill to limiting de minimis exemption to stablecoins only, and BPI continues to meet with lawmakers. But that doesn't say why there's been a shift. We can't just assume it's Brian. Unless I've got a letter from Brian Armstrong handwritten with his fucking signature on it, that's got like, sent to Elizabeth Warren saying, I think only stablecoin should have de minimis tax relief, but not Bitcoin. Unless I see something akin to that, then I'm classifying this whole thing as a rumor and should be taken with a grain of salt. So for all the people that are out there, and there are many of them that are losing their fucking minds over this, everybody take a breath. Calm down, man. You'll be fine. But then we've got crude oil. Out of CoinDesk, Omkar Godbold is writing this one. This startup wants to tokenize crude oil trading, and it's gearing up for a 2027 launch. Oh, this is going to be good. This is probably as good as bananas on the blockchain. Oil is the single most vital commodity, wielding an overbearing influence on all corners of the global economy. This reality was made painfully clear by recent war-led oil price spikes above $100 a barrel and the resulting financial market jitters. Yet, for all its immense importance, the machinery powering global oil trading largely remains archaic. It is dominated by massive legacy exchanges, extensive paperwork, and high barriers to entry that can deter all but the very largest of players. Baron Lamar, co-founder of the International Digital Exchange, a blockchain-based platform for tokenized oil, and identified as a former head of trading at Petronas, aims to revolutionize this, I guess by putting oil on the blockchain. His vision is to put oil on the blockchain. There it is, right there, with each litro, L-I-T-R-O token, representing 1 liter of real crude, targeting an early 2027 debut. The token's value will be indexed to popular global oil benchmarks such as your favorites, Brent, North Sea, and West Texas Intermediate. Quote, Litro's testnet and product demo rollout March through May of 2026, with official launch in January 2027, Lamar told CoinDesk in an interview. This project stands out for its ambition to remain strictly grounded in the real world. In contrast, much of the wider digital asset market remains flooded with speculative tokens bearing little connection to Main Street. Even the burgeoning real-world asset market, which reportedly stands at over $25 billion today, is predominantly driven by the tokenization of financial instruments such as government bonds. It is specifically designed to modernize what it describes as a $6 trillion global oil market's outdated paper-based system. Traditional commodity deals often drag through long supply chains involving multiple banks and clearinghouses, frequently delaying settlements by up to 90 days and locking up billions in vital capital. This issue is especially acute now, with conflicts in the Middle East disrupting supply chains and spiking market volatility. The current system, dominated by traditional exchanges like CME and ICE, often leaves a broad range of similar, smaller, and mid-sized investors sidelined due to high capital requirements and a lack of direct access. Litro's tokenization aims to resolve this by layering verified digital reserves on the blockchain. Okay, promising faster, more accessible, and more transparent trading. Here's how it works. Oh, thank God they're going to tell us how stupid works. Here's how it works. Oil producers pledge their certified reserves to the index platform. That's already a problem. These reserves are then meticulously verified by independent auditors for quality, authenticity, and ownership of the crude before any Litro tokens are minted. There's your second problem. You've just added a layer of cost. I love learning how stupid works. This is great. I always looked for the decision tree on how stupid actually moves from point A to point B, and I'm getting a crash course right fucking here. While the physical oil remains securely in custody at the producer's facility, the legal title to that oil is digitally assigned to the index system. Quote, only audited and verified reserves can be tokenized, Lamar explained, emphasizing that the tokens are minted on a strict one-to-one basis with physical oil volume. He added that the project is currently being built on Arbitrum, an Ethereum scaling solution while maintaining compatibility with any EVM compatible blockchain. That's Ethereum Virtual Machine, EVM. A key appeal for traders, Lamar asserts, is Litro's 24/7 liquidity and the promise of direct redemption. Holders of the token can redeem it for cash or, in theory, physical crude oil delivery, because everybody wants to store oil in their garage. Quote, redemption for physical oil is part of the design, Lamar said. Now, the platform boasts a sophisticated smart logistics routing system to facilitate this. Excuse me. The platform boasts a sophisticated smart logistics routing system to facilitate this. The system is designed to match oil grades, arrange vessels and terminals, issue electronic bills of lading and certificates, and coordinate delivery. This means that eventually token holders can take physical custody of the barrels they own digitally. Its intelligence layer connects digital tokens to physical delivery mechanisms, leveraging Internet of Things sensors, AIS vessel tracking, and AI-driven optimization to automate the entire redemption to delivery process. The project is clearly in its early stages. Lamar noted that Index is currently in discussions with Capital Union Bank to join as a banking partner. Other investor and partner deals are expected to be finalized once the minimum viable product is complete. If Lamar and his team successfully execute this ambitious vision, you spelled stupid wrong, it could mark a significant and necessary shift to how global energy markets operate. No, it won't. I'm not even going to read the rest of that fucking sentence. This is fucking stupid. Just like bananas on the blockchain was stupid. There's just no other way to look at this. Look, I got to go back up here to this sentence because it kind of set off an idea in my head while I was talking. It says, this is especially acute now, and they're talking about settlement delays of up to 90 days of oil settlement, right? This is especially acute now with conflicts in the Middle East disrupting supply chains and spiking market volatility. But I also want to take that and I want to marry it to this thing down here below where it says that what was going to do? They were going to audit and verify crude oil holdings at the complexes where the crude oil is actually stored, right? They're not going to transfer it. Okay, you got two things going on. You have a global supply that is produced in several countries around the world, and it's all moving on tankers all the time. Not all, okay, but a lot. I mean, there's a lot of movement. And what I'm getting at here is that the volume of any one of these places is going to change throughout the day. How are you going to effectively execute a quality audit when you've got 1 million barrels of oil that are now added to the reserves since the time that you began the audit to the time that you finished the audit? Even if you do it completely digitally using the volume sensors inside of all the tanks, you're still not going to be able to deliver that information quick enough to this index platform for it to do that much. Plus, you've got all the disruptions going on in the Middle East. You just laid it out. What I'm getting at is that you can't audit what is that volatile. And I'll tell you what, if you think you can, I want you to go find one of those dudes in the grocery store. Every once in a while, you'll see them once a quarter. And what they're doing is they're taking an inventory of that store, of all the products on the shelf live during the day while the store is open. And you ask them about how, is it really difficult to do an inventory while product is being put on the shelves as well as being taken off of the shelves? And what kind of logistics are behind doing an inventory when you've got live volume discrepancies happening in real time? Okay, that's just that part. And what I was saying about everybody's going to store barrels of oil in their garage, I get what they're doing. Like if you're making a large buy, like let's say there were jet fuel futures is what made Southwest Airlines what it is today. They were smart enough to trade jet fuel jet fuel futures back in I want to say the late 80s, mid to late 80s, somewhere. It was somewhere around there. I can't remember exactly where. But the story goes that they literally had what is akin to a jet oil or jet fuel trading desk at the corporate offices of Southwest Airlines, I think in Dallas. And they had a jet fuel trader. And that was this guy's job. And the guy put in a huge futures contract on the price. It was a huge short. And he won. He won that fucking short. But instead of taking the money, they took physical delivery of really, really cheap jet fuel. Very quickly after that, jet fuel prices, along with all the rest of the petroleum products, spiked way back up into where it was or into the stratosphere and then kind of settled back down to where it was. So Southwest Airlines is sitting on physical jet fuel because they took physical delivery of it. And it's cheap to them or for them to fly their aircraft in comparison to all the other competitors. And they leveraged that moment in time to become one of the most well-known, most well-run, not anymore from what I'm getting reports that it's starting to suck, but for the longest time, they had millionaire baggage handlers because they had allowed all of their employees to actually vest in Southwest stock. That one move made that company. So I get taking physical delivery at corporate scale, but the rest of this is just stupid. This is the dumbest thing that I've ever seen. I think this is going absolutely nowhere, but stupid is as stupid does. But this one doesn't feel stupid. Tether backs Arc Labs. They make a $5.2 million bet on Bitcoin's stablecoin revival. Andre Bagansky is writing this one for Decrypt. Tether has backed Arc Labs in a $5.2 million seed round as the Bitcoin infrastructure startup aims to expand stablecoin activity on Bitcoin through Arcade, the firm's programmable layer. The Lugano, Switzerland-based firm plans to use the funding to bolster the Bitcoin network's use in supporting stablecoins and digital representations of real-world assets, according to an announcement on Thursday. Tokenized assets primarily exist on networks like Ethereum and Solana that natively support smart contracts, but Arc Labs is betting that tides could shift as Bitcoin-based infrastructure supports commercial functions such as authorizations, merchant holds, and escrow. The company's latest funding round was also backed by Anchorage Digital, a federally chartered digital asset bank, helping Tether gain a regulated foothold in the United States. Ralph Ho, I guess Don Ho's cousin, PayPal's former vice president and treasurer, and several venture capital firms participated, bringing Arc's total institutional backing to over $7.7 million per the announcement. Arcade seeks to improve upon Bitcoin's existing scalability by executing transactions off-chain, a design feature that also prevents the movement of funds from being broadcast publicly. Although users essentially have to lock up their Bitcoin and trust a central server to participate in the activity, Arcade is designed to allow people to retrieve their Bitcoin if things go bad, according to Arc Labs, that is. Quote, if the server happens to go offline for whatever reason, you keep a copy of your latest Bitcoin balance as a pre-signed transaction that the server gave you. And then if the server goes away, you get to broadcast those transactions on chain. And then you're left with vanilla Bitcoin. It's fucking brilliant. It's brilliant. I love this. And that was Alex Bergeron, head of ecosystems at Arc Labs. Tether hasn't committed to issuing its flagship stablecoin on Arcade yet, Bergeron added, noting that its support for assets beyond Bitcoin hasn't been battle tested. But Arc Labs hopes that the company could become part of USDT's $184 billion footprint by year end. Tether ended support for USDT on Omni in 2023, the Bitcoin layer on which the stablecoin was launched back in 2014. Bergeron said Arc Labs has already secured a smaller issuer widely used across the global south. Regarding Lugano, Tether announced a partnership with the Italian-speaking city in 2022 to establish the area as a blockchain hub. And we talked all about that earlier in earlier episodes, so we're not going to get into that. But this is really cool. So think of it. Think of being able to use Bitcoin off-chain, but the way that the transaction is structured looks like an on-chain transaction, would read as an on-chain transaction, however it's used off-chain. So it's basically saying, hey, look, there's no reason for us to have a special protocol, a special type of transaction to do this. So like Lightning Network, which does have its own special transaction stuff. And you can't give a Lightning transaction you cannot make a transaction on the Bitcoin blockchain with that. It won't read. It won't be valid. It will just look like gobbledygook. But these are different. These give you a redemption sheet, and that redemption sheet that redemption itself is completely understandable as a transaction on the Bitcoin blockchain. So like Bergeron said, if something goes kaplooey, you can just give that transaction to the Bitcoin blockchain and you're good. Honestly, I love that, because that starts making it look like there's a continuous flow from Bitcoin into something else and then back into Bitcoin, instead of something coming from Bitcoin, then stopping, being converted, then used in this other system, and then stopping, and then being converted back to a language Bitcoin can understand and sent back. This seems more like a branch of a river that goes off as a small stream and then later on connects back with the original river. I love the way this is sounding. I think this is going to be really good. And you know what? It doesn't make me feel dirty at all. But if it did, I'd go to my friend SoapMiner over at SoapMiner.com, where he's got handmade tallow soap. It's the best soap that I've ever used. I'm not lying. I've tried all kinds of people's handmade soaps. I'll go to farmers markets and I look at labels now like hardcore, because all I ever see is olive oil, coconut oil based. Some of them are like halvesies, 50% beef tallow, 50%, olive oil, not SoapMiner. SoapMiner is 100% grass-fed beef tallow as its fat base. Then it's got lye, which all soap is made with. And then you've got distilled water. That's the base of his soap. He'll put in some peppermint essence in there to make peppermint soap. He'll put in a little bit of colored sand to make like a little bit of different colors. But dude, all his soaps are 100% natural products, and I use it exclusively. Go to SoapMiner.com. Make sure that you use the code Bitcoin and to get 10% off your entire purchase of my favorite handmade tallow soap. And you buy it in Bitcoin, because if you're not selling it in Bitcoin, you're not in the Circle P. But SoapMiner is, because the Circle P is where I bring plebs like you with goods and services to plebs just like you that have goods and services that you may want to actually purchase but you're going to be buying in Bitcoin, because if you're not selling it in Bitcoin, you're not in the Circle P. Go to SoapMiner.com. That's SoapMiner.com. Use Bitcoin and for a 10% off your entire purchase. Prosecutors are getting pissed off and annoyed at Sam Bankman-Fried because he keeps requesting a retrial. This is Timmy Shin out of The Block, and it says U.S. prosecutors have urged a judge to reject a request by former FTX CEO Sam Bankman-Fried for a new trial, arguing that the jailed crypto executive has failed to present any legitimate new evidence. Bankman-Fried's motion, filed in February by his mommy on his behalf, adduced new evidence to relitigate a case in which a 2023 jury convicted him of fraud and conspiracy tied to the collapse of FTX. He is currently serving 25 years. In the February motion, Bankman-Fried argued that two former FTX executives, Chapsky and Salami, could have challenged prosecutors' narrative that he defrauded FTX customers had they testified. The former CEO claimed that both declined to testify due to fear of retaliation. According to a Wednesday filing, prosecutors rejected that argument, stating that the witnesses were, quote, fully known to the defense before trial, meaning that their testimony does not qualify as newly discovered evidence. Further, quote, the defense's decision not to put the witness on his witness list or compel their testimony forecloses any claim that their post-trial views are, quote, newly discovered, the prosecutor said. Ooh, they're just really taking him to the woodshed. The prosecutors also argued that even if the testimony was considered, it would not have changed the outcome of the case because of the overwhelming evidence demonstrating that Bankman-Fried directed the transfer of billions of dollars in customer funds to Alameda. Bankman-Fried's motion also repeated his longstanding claim that FTX was not insolvent. Right. The prosecutors dismissed that argument, saying that FTX lacked the cryptocurrency it promised customers, at one point holding only about 105 Bitcoin against customer claims approaching 100,000 Bitcoin. They added that the eventual recovery of assets through bankruptcy proceedings does not justify the underlying crime. Quote, the motion's most aggressive claim that FTX was solvent is factually wrong, legally irrelevant, and deeply misleading, the prosecutor said. Quote, as this court observed previously, criminal fraud is complete at the moment of misappropriation. End quote. Prosecutors further criticized Bankman-Fried's claims that the case represented political persecution by the Biden administration. They noted that Bankman-Fried was a major Democratic donor in recent election cycles and that his campaign finance violations were committed to facilitate those very contributions. Quote, the defendant's weaponization narrative offers no basis for a new trial. The defendant was one of the largest Democratic donors in the 2020 and 2022, and his campaign finance crimes were in furtherance of making those contributions. So the notion that he was targeted for his Democratic politics by the prior presidential administration is fanciful. End quote. There you go. That kid doesn't need to be out on the street anytime soon. Let's run the numbers. CNBC futures and commodities, and damn, those prices are just too damn high. Brent North Sea up 8.6% this morning, $99.92. Hello 100. Same for West Texas Intermediate. It's up 9.5 points to $95.05. Natural gas is up half a point to $3.22 per thousand. Gasoline up 4.1, knocking on $3 a gallon gas. Merbon crude, check this shit out. It is up 16.5% to $117.3. Why, might you ask? Well, I finally found out where the hell Merbon crude comes from. It comes from the UAE and around that area. So the same part of the world that is completely embroiled in this Iran, United States, Israel mess. And it's really close. If you don't know where the UAE is, it's really, really close to all this bullshit, right? So it looks like they're not able to get their oil out to the market. And why do people want it? Because it's a light, sweet crude. What does that mean? It's not heavy. It's not intermediate like West Texas Intermediate. It's light, sweet, which means that a lot of the hydrocarbon chains of what you would think of as crude oil have broken down and have become lighter, which means that you can refine a fuck ton more gasoline and diesel and jet fuel out of it than you can asphalt, motor oil, and the rest of the stuff that comes out of stuff like intermediate to heavy crude. And heavy crude is what you'll find in the tar sands of Canada, as well as all those oil reserves we keep dancing around about with Venezuela. It's difficult oil to get out of the ground. It's difficult to move. It's difficult to pipe. it's difficult to refine. Light sweet crude is like maple syrup to refiners. They love this shit. That's why it's A, so expensive anyway, and B, why this shit has shot up like to the stratosphere, because they cannot move it, and all the refiners want it. So if you ever wondered that, all oil is the same, it is not. Metals, having a bad day. Palladium is down a point. Gold is down almost a point. 5,135 and 7 dimes there. Platinum down 2 1/3. Silver is slightly down, but chilling out at 85.42, and copper is down 0.37%. Ag is almost all in the green today. Can't imagine why. Shipping seems like it's going to be fairly disrupted, but whatever. There's a lot of stuff that goes through the Straits of Hormuz. It ain't just oil. All right. That's actually a lot of ag commodities go through there because it's desert. They can't grow shit. They need to get it from other places. Chocolate is the only loser of the day, and it's down bad, 4.25% to the downside. Biggest winner is coffee, 1.5% to the upside. Meanwhile, live cattle up 0.6%, lean hogs down 0.7%, and feeder cattle up 0.17%. The S&P is down a point, NASDAQ is down 1.19%, Dow is down a point, and the S&P Mini is down 1.17%. And then there's Bitcoin chilling at $70,170. That's a $1.4 trillion market cap. We can now get 13.6 ounces of our favorite shiny metal rock with our one Bitcoin, of which there are 20,001,066.78. And average fees per block are nominal, 0.02 BTC taken in fees on a per block basis. There are 30 blocks carrying 33,000 transactions, waiting to clear at high priority rates of 3 sats per VByte. Lows get you in at 0.6. And mining, exactly sitting at 1 zettahash per second. That is the strength of the backing power of the Bitcoin network, and it's more than enough for me. From Civil AI, yesterday's episode of Bitcoin and Jay was 6,300 sats, says, many thanks, good sir. No, thanks to you, Jay. I appreciate the support. Nick Dose with 168 says, cheers. Right back at you, pal. Nostr Gang with 100 says, nothing but thank you for your support, Nostr Gang. I appreciate it. Please donate to the show. Stream me Satoshis. Give me boostograms. Announce your wedding. Announce your Bitcoin meetup. I've almost said almost anything. There's been like maybe one time that I was just unable to read something because it was kind of, I can get pretty salty on this podcast, but it was a little too salty. Anyway, that's the weather report. Welcome to part 2 of the news that you can use. The SEC and CFTC in unholy matrimony, ending years of rivalry with a deal that will mean combined crypto oversight. This is important. Listen up. Jesse Hamilton, CoinDesk. The U.S. market regulators are melding their operations in the places where the duties of the SEC and the CFTC overlap, and building a crypto oversight framework is listed among the core aims of a written agreement released on Wednesday. Most of the objectives of the Memorandum of Understanding in combining supervision, product approvals, and policy interpretations, alongside coordinating enforcement actions and providing dual registration, will affect the regulated majority of the crypto sector. But the agreement also specifically listed, quote, providing a fit-for-purpose regulatory framework for crypto assets and other emerging technologies as a top goal. Paul Atkins, SEC chairman, had previewed the MOU in Tuesday's remarks, detailing how the agencies are offering contact information for regulated firms to call combined meetings to discuss policy matters and product applications. Quote, for decades, regulatory turf wars, duplicative agency registrations and different sets of regulations between the SEC and CFTC have stifled innovation and pushed market participants to other jurisdictions, Atkins said. Quote, by aligning regulatory definitions, coordinating oversight, and facilitating seamless, secure data sharing between agencies, we will ensure our rules and regulations deliver the clarity market participants deserve, end quote. The new agreement says the staff of the CFTC and SEC will meet regularly to share data on mutual interests. That includes enforcement actions, which have historically been pursued independently, sometimes leaving a crypto firm confronted with similar accusations by not one but both agencies. If the two regulators overlap in an enforcement case, they're agreeing to, quote, confer on potential charges and relief, sequencing of filings, litigation strategy, and public communications. During the previous administration, other crypto positions of the two agencies sometimes directly contradicted each other, including how certain assets were being placed in which bucket, a securities bucket or a commodities bucket. Just don't kick the bucket. Now, their enthusiasm for friendly crypto rules is mutual and essentially unopposed, with the CFTC run by a sole Republican chairman on an otherwise empty 5-member commission, and the SEC led by Atkins and 2 other Republicans, with the Democrat seats kept vacant. The chairman of the agencies were both appointed by Donald Trump, who arrived in the president's office last year with a newfound enthusiasm for crypto, stemming in part from his own growing business interests. Both Atkins and Mike Selig had worked for crypto clients prior to taking their jobs. This is beyond a handshake. And this is actually, my gut feeling is this is going to happen. In fact, what I suspect is going to happen before Trump's out of office is either the SEC and the CFTC collapse into one agency altogether, or they are very, very close to doing so. So we'll have to see. But that, I think the days of us seeing 2 separate agencies, one for equities and one for commodities, I think those days are numbered. Now, on to Her Majesty's Revenue and Customs Service, exploring crypto forensic tools for tax probes as former OECD advisor flags UK's growing compliance push. This is James Hunt writing for The Block. Oh, not Her Majesty's. I'm stuck in the old world. It's His Majesty's Revenue and Customs now is exploring the procurement of crypto forensic software and investigative support services as part of efforts to combat, of course, money laundering and tax fraud involving digital assets. The market engagement notice published on the UK government's tender platform this week outlines a potential procurement for licenses to blockchain tracing software, forensic investigative support, and tools that allow investigators to query blockchain data at scale. The initiative is intended to support His Majesty's Revenue and Customs Fraud Investigation Service and Risk and Intelligence Service, which handle serious fraud investigations. HMRC said the tools under construction would enable capabilities such as automated triage of cases, deep forensic analytics, cross-chain transaction tracing, attribution and risk scoring, and advanced data visualization. The department also highlighted the need for secure and compliant operations, along with training and administrative oversight for investigators. The tax authority is potentially considering procuring 2 contracts through a single approach with a combined estimated value of £3.42 million sterling, excluding value-added tax, over 3 years. The contracts are expected to run from April the 1st to March the 31st, from years 2027 to 2029, with a possible extension through March 31st, 2030. One contract would provide 55 licenses and 550 hours of investigative support annually, while the second would include 20 licenses, but only 200 hours of support alongside training programs for investigators. The notice is part of a preliminary process designed to gather insights from potential suppliers before any formal tender is issued. HMRC said participation in the exercise would not influence future procurement decisions and noted that the final scope and timeline could change. Commenting on the development, Colby Mangles, love his name, global head of government solutions at TaxBit and a former OECD advisor, said the initiative reflects a broader shift among governments toward building compliance infrastructure for digital assets. Quote, HMRC's latest engagement with the crypto industry reflects a broader shift that we're seeing globally. Governments recognize that digital assets are becoming a significant part of the financial landscape, which requires compliance infrastructure, Mangles told Block. Quote, what's significant about this engagement is the level of sophistication His Majesty's Revenue and Customs is seeking, end quote. Mangles said that the investment aligns with the UK government's ambition to become a global crypto hub, noting the country recently became one of the very first jurisdictions to implement the OECD's crypto asset reporting framework. Quote, all of these steps are a clear signal that the United Kingdom intends to lead by example for crypto compliance, enforcement, and transparency. Yeah, it's coming. But the real meat underneath this is we are so far ahead of all of these assholes. And for some reason, they just think, I think they really think that we have reached some kind of pinnacle, some kind of plateau of the underlying infrastructure and code bases used for quote unquote Bitcoin and the shitcoin field. It's not. It's nowhere close. There's so much stuff coming out. These people, they could spend $30 million over 10 years. They could spend $500 million over 1 year. It's not going to matter. By the end of the year, by the time they get all this shit set up and all of their agents trained and all of the pieces of the little puzzle in place, the entire landscape is going to be radically different again. And hopefully it'll stay that way. On to China, where the fraud victims challenged the United Kingdom's redress plan for 61,000 seized Bitcoin. This is out of Financial Times. Victims of a Chinese investment fraud are challenging a UK proposal to compensate them through a Chinese redress scheme, arguing the plan could leave British authorities holding much of the upside from roughly 61,000 Bitcoin seized in a money laundering investigation. According to the report, citing court documents, the dispute has moved into the UK High Court as groups representing victims seek to recover funds linked to the cryptocurrency seized by police in London. The Bitcoin haul is now worth about 3.2 billion pounds sterling after rising sharply in value since the assets were confiscated. Well, law firm Candy, it's spelled Candey, but I guess it's pronounced Candy. Call my law firm. Call Candy, which represents about 5,700 victims, said that the proposed compensation arrangement may not guarantee fair restitution. The fraud scheme itself reportedly affected more than 128,000 investors in China, according to court documents. The case highlights growing legal questions around crypto seizures, where digital assets can appreciate significantly between confiscation and restitution. The dispute stems from a Chinese investment fraud scheme that ran between 2014 and 17 and defrauded a whole bunch of people. Prosecutors reportedly argue that some of the legal claims could allow a subset of the victims and litigation funders to recover sums exceeding their actual losses. Martin Evans, KC, representing the Director of Public Prosecution, said in court submissions that the claims risk benefiting a small subset of victims and their litigation funders while excluding other victims and the Crown. Oh, because we got to pay up to the Crown. Candy defended the legal action, saying court proceedings give victims the best chance of securing proper compensation and noting that its legal fees are capped at 18% of any recovered funds. A preliminary hearing is scheduled for July to determine whether English or Chinese law should govern the claims to the seized Bitcoin. The High Court has also set a May 22nd deadline for claimants seeking recovery under Section 281. British authorities seized more than 61,000 Bitcoin during a 2018 raid on a London property linked to Jian Wen, who was later convicted of money laundering, and Zimin Kwan, the mastermind of the scheme, who was sentenced in a UK court to over 11 years in prison. Wen attracted attention after buying or attempting to buy a luxury London mansion using Bitcoin and failing to explain the origin of the funds. So, yeah. I mean, it's Chinese. It seems to me this case needs to be in China. The fact that it was broke open by the UK, I get that, but unless they're going to claim maritime salvage law or something, this is clearly bouncing in the Chinese court. These are all Chinese people. The people that defrauded were in China. Or the people that defrauded are Chinese as well. It seems a lot of this happened on Chinese soil. This is a China incident. It should be argued over in China, but the Crown wants his money. The Crown wants his money. They're going to battle for jurisdiction on this case, and nobody's going to get compensated for years, probably. But on to greener pastures, where Android vulnerability exposes wallet seed phrases. Holy shit. 25% of devices with MediaTek chips are at risk, Atlas 21. Ledger's Donjon security team has uncovered an Android vulnerability that could put millions of users worldwide at risk. The discovery affects devices equipped with MediaTek processors that could allow attackers to extract wallet pins and private keys in as little as 45 seconds. The security flaw exploits a weakness in the secure boot chain of MediaTek chips. According to Ledger, an attacker with physical access to a smartphone can connect it via USB before the operating system fully loads, extract the private keys that protect Android's disk encryption, and then subsequently decrypt all data stored on the device offline. During a demonstration test, the researchers managed to recover sensitive information from several wallet applications, including Trust Wallet, Kraken Wallet, and Phantom. Ledger experts estimate that around 25% of Android smartphones currently in circulation could be vulnerable to the attack. The flaw particularly affects the MediaTek processor containing phones in combination with the Trust Sonic Secure Execution environment. No, I do not know exactly what that means. Quote from Charles Guillemont, Chief Technology Officer of Ledger. This research demonstrates what we have long argued. Smartphones were never designed to function as vaults. While this vulnerability can be patched, and we encourage all users to update their devices with the latest security fixes provided by MediaTek and manufacturers, it does highlight the inherent challenge of storing secrets on devices that are not secure, end quote. According to a report by TRM Labs, a blockchain intelligence firm, infrastructure attacks, including private key thefts, I messed that up. Including private key theft, seed phrase, man, I'm running out of steam here. Seed phrase theft and front-end compromises account for more than 80% of the $2.1 billion stolen in the first half of 2025. There, finally got through it. Guys, if you've got a Android phone, check if you've got a MediaTek inside of it with the Trust Sonic Secure Execution environment. How you find that out is beyond me. I don't have an Android phone, but go check. And never, ever keep your private seed phrase for your Bitcoin on your phone. And you won't have this problem. On to Metaplanet. They deepened their Bitcoin strategy with $25 million investment plan plus a new venture arm, Vismaya V from Decrypt. Metaplanet is moving to broaden its Bitcoin strategy beyond simply accumulating the Bitcoin, unveiling a new venture arm and investment initiative aimed at supporting Japanese emerging Bitcoin infrastructure ecosystem. The Tokyo-listed firm said on Thursday that its board had approved the creation of Metaplanet Ventures and Metaplanet Asset Management, alongside plans to deploy roughly $25 million over the next 2 to 3 years into companies building Bitcoin financial infrastructure across lending, payments, custody, derivatives, and compliance technologies. Planned initiatives include venture investments in early and growth stage companies, an incubator for Japanese founders, and grants for open source Bitcoin developers and educators, according to the company filing. Quote, Japan has built the best regulatory framework in the world for digital assets. Now it needs the companies, the builders, and the infrastructures to match, said CEO Simon Gurovich. Mushir Ahmed, founder and managing director of FinStep Asia, told Decrypt Investments Decrypt that its investment is relatively small for Japan's scale, but said it could help drive more local blockchain startups to build products and services for the Bitcoin ecosystems beyond basic mining and payments. The expansion is a strategic pivot from a firm grappling with financial strain led to Bitcoin's volatility. Yeah, I'll bet. Metaplanet currently holds 35,102 Bitcoin, worth approximately $2.4 billion. Wow. As Bitcoin current price is 69,540. Last month, the firm disclosed a full year loss of $605 million. The point is, they're not stopping. I remember, because it wasn't too long ago, when the Bitcoin price started crashing October the 10th of last year, and we just kept coming down, as Bitcoin is wont to do sometimes. There were so many people saying, see these, and now these treasury firms that you thought were all hot and shit, they're going to go away. First, I always thought that this is not a good play. I just buy the Bitcoin. Don't buy stock in Metaplanet and Strategy. It's kind of dumb. Second, they were wrong. They're not going away. It doesn't matter if the ideas are stupid. It doesn't matter if you can just hold your own Bitcoin and that's what you do. It doesn't matter. It is very clear that there is a market for these companies' further existence, to the point that Metaplanet isn't folding up shop. They're not selling all their Bitcoin, and they haven't filed bankruptcy. They are starting an asset management company as well as a venture capital firm. They're not stopping. I think that that's important to note. Whether or not we think treasury companies are dumb, personally, I do. I think Metaplanet and Strategy will survive. The top 5 will survive, but the rest of them, who gives a shit? I mean, it's like, a lot of these were Me Too movements. Look what happens to the stock price when people announce that they're buying Bitcoin at their company. That's all that they did. They didn't really care about the asset. They don't care what it means. They don't really care about Michael Saylor's playbook. All they see is, say Bitcoin, stock price go up. And sadly, we're dealing with the fallout of that kind of Me Too, follow the leader movement. Because they didn't know what the asset meant, because they don't really know how to hold it, and they don't really know how to leverage it like Mike does. And God knows Mike knows how to leverage this shit, whether you like him or not. He knows how to leverage this stuff. They don't. And so when we see all these Forbes articles coming out just going, ha ha, and pointing and laughing like they usually do, what they're not getting is that they're pointing and laughing at the same people that we're pointing and laughing at. I think it's great, man. I think it's great. Finally, for the last of the show, Cosmos Health buys $600,000 in Bitcoin and expands digital asset treasury. Bitcoin Magazine's Micah Zimmerman writing. Cosmos Health Incorporated announced $600,000 buy of Bitcoin. Yay. Following the latest purchase, the healthcare company said its total investment in digital assets now stands at approximately $3.1 million. Chief Executive Officer Greg Siokas said that the company views select digital assets as an attractive asset class. He added that Cosmos Health is building its position through a disciplined treasury approach designed to diversify the company's balance sheet while maintaining financial flexibility. So Cosmos is another company that I had not heard the name of. And what I find fascinating is that it's a healthcare company. This is sort of It's not really a trend, but I'm seeing, a good fistful of healthcare companies starting, have been doing this, and Cosmos seems to be making the same play. So it'll be interesting to see if Bitcoin changes healthcare at all. So that's the end. That's the last article of the day. Right at 60 minutes. I will see you on the other side. This has been Bitcoin and I'm your host, David Bennett. I hope you enjoyed today's episode and hope to see you again real soon. Have a great day.